everybody, this is Swati Gupta, Chartered Accountant. Welcome to lecture number 70. Before we go ahead, I would like to wish you a very happy Independence Day. This lecture is in continuation with lecture number 16, where we discussed the first 13 illustrations of Ind AS 115 as per the ICAI module chapter number 3. Here in this lecture, we will continue and cover from 14 till 30 illustrations. Okay, let's begin. Please refer your ICAI module throughout along with the lecture. For full course, definitely check out the description box and DM me on my Insta in case of any doubt. Okay. Firstly, illustration number 14 on page number 3.27 of our ICAI module. Entity A, a specialty construction firm, enters into a contract with Entity B to design and construct a multi-level shopping center with a customer car parking facility. Okay, they are designing a building as well as a car parking facility located in sub-levels underneath the shopping center in the basements. Entity B solicited bids from multiple firms on both phases of the project, design and construction. Okay, they are soliciting, there have been tenders issued, bids are going on. Whoever charges the lowest price, the contract will be handed over to that particular firm or entity. Okay, so bids are being asked for, solicited. The design and construction of the shopping center and parking facility involves multiple goods and services from architectural construction and engineering through procurement and installation of all the material. Several of these goods and services could be considered separate performance obligation because entity A frequently sells these services. Okay, so it is saying that since these services are separately sellable, designing, construction, car parking facility and all, okay, so these can be separate, these are therefore separately identifiable, and therefore it is saying that it should be separate performance obligation. Whereas entity A frequently sells the services such as architectural, consulting and engineering services as well as standalone construction services based on third party design separately. Okay, these services can be sold on an individual separate basis. Entity A may require to continually alter the design of the shopping center and parking facility during construction as well as continually assess the propriety of the materials initially selected for the project. See, there is again and again revision done in the designing part. Okay, so is construction dependent on the designing part? If designing is done, revised again and again, any changes are made again and again, okay, throughout, then it directly impacts what? The construction part. So therefore this designing and construction might be in a normal routine sold, can be sold separately, but here they are vastly interconnected. They are closely interconnected, they are highly interdependent. Therefore, it has to be one contract in terms, one performance obligation in terms of the contract, in context of the contract. Okay. Please see the solution. If you are preparing for the ICAI, do read the solution and observe the writing pattern. See, the design and construction phases are highly dependent on one another and therefore it should be considered as one single performance obligation. Despite they can be so standalone, selling price can be allotted to them. Despite they can be in general version, they are sold separately. Okay. Next, illustration number 15. An entity, a software developer, enters into a contract with a customer to transfer a software license, perform an installation service and provide unspecified software updates and technical support online and telephone for a 2-year period. Okay, there has been a software license, perform an installation service and provides unspecified software updates and technical support. Okay, 4 services are there, 4 goods and services are there. For a 2-year period, the entity sells the license, installation service and technical support separately. The installation service includes changing the web screen for each type of the user. Okay, the GUI, the user interface has been changed. Okay, each type of user For example, marketing, inventory management and information technology. So it basically is a software which gives different UIs, user interface, for different departments. If one is of marketing, they might be needing some other data. Okay, whereas if somebody is managing the inventory, they might be requiring some other data. Okay, so their user interface is customized accordingly, updated accordingly. The installation service is routinely performed by other entities and does not significantly modify the software. So in the context of contract, as you know, that there was a term that it should not be highly interdependent or highly, you can say, interrelated, and secondly, the changes must not be such significant that they modify the existing one. They must not vastly impact. So here it is saying that they does not significantly modify the software. The software remains functional without the updates and the technical support as well. There is no significant changes made to the software. Okay. Determine how many performance obligations does the entity have. Since there are 4 different services, okay, then therefore there are 4 performance obligations: software license and installation service, software updates, technical support. Okay, these are 4 performance obligations. These can be identified separately. In case if we talk about next illustration, this will make you more clear. Please continue and watch the video. This illustration will make the illustration number 15 more clear. Okay, see here what is the case. The promised goods and services are the same in the above illustration. These 4 particular services are being given same to same, except that the contract specifies that as part of the installation service, the software is to be substantially customized. Okay, it needs to be highly customized to add significant new functionality to enable the software to interface with other customized software applications used by the customer. The customized installation service can be provided by the other entities. It can be provided by the other entities, but it is highly dependent, highly interrelated. It is so significant that it will modify. It will make a vast modification in the existing software. Okay, so this installation part, okay, so this update part is very much critical, very much significant. It is somehow modifying the existing one. Since it is interrelated, highly modifying, highly impacting, therefore it will be considered as one particular contract. Okay, so therefore in the above case there were 4 separate performance obligations. Here the installation and the software, since they are highly interrelated, they will be considered as one performance obligation, and software updates and technical support will be separate. So in this case 3 performance obligations will be there. One is clubbed with the software one because it is highly interrelated. See, these are distinct, no matter, these are distinct. Software is significantly modified and customized by the services. Okay, so therefore not separately identifiable. So therefore the answer should be 3 performance obligations. 3 performance obligations, 1 customized installation plus the software. Second, software updates and technical support. Are you clear? What is the difference between illustration number 15 and 16? There are 4 separate performance obligations because it is not highly interrelated. Here 2 activities are highly interrelated and therefore they are clubbed as one performance obligation. Next, head towards illustration number 17. Telco T Limited enters into a 2-year contract for internet service with customer C. C also buys a modem and a router from T Limited and obtains title to the equipment. We have learned this, okay, we have gone through this same example in the notes part as well. T does not require customer to purchase its modem and router and will provide internet services to the customer using other equipments that is compatible with T Limited's network. There is a secondary market in the modem, which modems and routers can be bought and sold from amounts greater than the scrap value. It is said that the routers, the things that are being purchased and the service that is being taken is not very much important that it should be taken from the same entity, Telco T Limited. Okay, it can be taken from separate vendors as well. So these are separately identifiable. If separately identifiable, therefore they can be treated as separate performance obligation. Okay, so these are capable of being distinct. Distinct means are in a capacity of being used on their own or with the readily available resources. And in the context of the contract, it should not be having a significant or a modification to the existing goods and services. Secondly, it should not be highly interrelated, highly integrated, okay, highly dependent. And therefore, it is said that there are 3 performance obligations. Okay. Now, next illustration number 18. V Limited grants customer C a 3-year license for antivirus software. Okay, 3-year license. Under the contract, V Limited promises to provide C with when and if available updates to that software during the license. The updates are critical, are very much important, are significant. They will be modifying the existing one. They are very much critical, they are very much important. If yes, then they are clubbed as one and treated as one performance obligation. If such installation or the other service part is not highly interrelated, not highly impacting, not significant enough to modify the existing one, then it can be treated as separate performance obligation. One concept is being repeated again and again, and separate type of case study is given to ensure that are you clear with the applicability of separate performance obligation and when to consider same performance obligation. Okay, I hope you are clear. In case of doubt, please let me know. Either you can comment down or you can download the app from the description box and chat with me. Okay, however, V Limited concludes that the license and the updates are not separately identifiable because the software and the service are inputs. See, since it is critical, these are not separately identifiable, they are highly interrelated and therefore one performance obligation. Okay, single performance obligation. Next, illustration number 19. Media company P Limited offers magazine subscription to customer. When customer subscribe, they receive a printed copy as well as online copy of the same magazine. Okay, whenever they are subscribing, they are receiving 2 copies of the same magazine, one online and one hard copy printed one out. Okay, so these 2 can be benefited separately on their own. It has whole 2 material, there is no cross reference given. Instead, only the format is different. Okay, the goods and are different, the format is different of supplying the same magazine. Okay, but they are distinct. Why distinct? They have a capacity of being used on their own completely without use of any other resources. Okay, so how many performance obligations? Separate performance obligation must be identified. Okay, so separate performance obligation must be identified, 2 performance obligations. Okay, read these. The printed copies and online access are both capable of being distinct. Both capable of being distinct because the customer could use them on their own. Next, illustration number 20, page number 3.31. Are you able to catch up with me? Please let me know. Illustration number 20, implied promise to resellers customer. Software company K Limited enters into a contract with reseller D, which then sells software products to end users. K Limited has a customary business practice. What is it? Customary business practices. It is its past business practices that every time it deals into such a particular transaction, it carries out such and such activity along with it without specifically specifying or laying it down. Okay, without stating it separately, it always carries out any particular activity while it is doing the same kind of transaction. Okay, so this is known as business customary practices. Or providing free telephone support. Okay, it always provides free telephone support to end users without involving the reseller, and both reseller and the customer expect K Limited to continue to provide this support. Determine how many performance obligations does the entity K Limited have. It can be identified separately. It can be identified separately, but this is implied promise. Implied promise means any promise, any clause that is not being discussed at the time of transaction. It is implied, it is taken for granted. You can say it is taken obviously that yes, whenever a particular entity is doing this particular transaction, it will always be providing a free telephone support. Okay, so therefore the definition meets K Limited notes that the promise to provide telephone support free of charge to end users is considered as a service considered as a service that meets the definition of a particular performance obligation when control of the software product transfers to D. As a result, K Limited accounts for the telephone support as separate performance obligation. Why separate? Even though it is implied, it should be calculated as separate performance obligation. Next, illustration number 21. Implied performance obligation. Car maker N Limited has a historical practice of offering free maintenance services. Every time car maker deals with any transaction of selling car, okay, it always offers free maintenance service. It is its past business practices. Okay, it is its historical business practice. It never has to say it separately. Example, oil changes and tire rotation for 2 years to the end customer of dealers who buy its vehicle. However, the 2-year free maintenance is not explicitly stated. If it is not stated separately at the time of negotiation, at the time of cracking the deal, it is termed as implied, or you can say implicit. It will be termed as explicit when it will be discussed at the point of negotiation, at the point of dealing into the transaction. So with its dealer, but it is typically stated in its advertisement. So due to any public document published or due to its own past business practices, if it is to carry out any other performance obligation, then it will be treated as separate performance obligation. Okay, so the maintenance is treated as separate performance obligation, even though it is implied and not negotiated separately, even though it is free of charge. Next, illustration number 22. Entity sells gym membership of rupees 7,500 per year to 100 customers with an option to renew at a discount in second and third year. Okay, it is of 3 year. Okay, 3 year at the rate rupees 6,000 per year. Entity estimates an annual attrition rate of 50% each year. That every time, if first year 100 people come, second time 50% will not be repeated, only 50% will repeat. Attrition means not repeat, leaving the entity. Okay, leaving the entity. Leaving. Okay, attrition means leaving the job or leaving the contract. So it is highly expected that 50% will leave every year. So first year there were 100. In second year there will be 50. And in third year again 50% will fall down and there will be only 25. That's how in total there will be only 175. Okay, there will be only 175. Okay, now you need to charge 7,500 for first 100, then 6,000 for 50 in second year, and 25 for this, and 25 customers will be charged 6,000 only. Okay, so this is how you will take out the revenue of amount of revenue that will be recorded. See, there are 175 members, year 100, 50 and 25. This is how 175 totals up. 7,500 will be 100 customers. In next year the charges are 6,000 and in next year it charges are 6,000. There will be 50 customers and in next 25 customers. There might be new customers coming up, but the offer is only for the existing one. Allocated price per membership is 6,857. How come? This 12 lakh divided by 175. 12 lakh divided by 175 is 6,857. Based on above, it is to be noted that although entity has collected 7,500, but revenue can be recognized at 6,857 approx per membership, and remaining 643 should be recorded as contract liability against option given to customer for renewing their membership at discount. This should be treated as contract liability. Whenever the discount is encashed, then it will be reversed from here. Okay, this is very important and very good question. Next, illustration number 23. An entity enters into a contract for the sale of product A for 1,000. As a part of the contract, the entity gives the customer a 40% discount voucher for any further future purchase up to rupees 1,000 in the next 30 days. The entity intends to offer a 10% discount on all sales. See, very important. You record the discount, you record the additional discount only if it is additional. Only if it is other than the normal. If 10% is being given to all the members and 40% is given to this purchase, okay, so only 30% is extra. Only 30% extra discount is given. 10% was generally given to all the buyers in next 30 days as part of a seasonal promotion. The 10% discount cannot be used in addition to the 40% discount. Okay, the entity believes that there is 80% likelihood that a customer will redeem the voucher, and on an average a customer will purchase rupees 500 additional product. So 500 product, okay, rupees 500 into 80%. There are high chances that only 80% will be given. Okay, and into 30%. Why 30%? Because 30% is only the actual amount, actual discount that is being given. So 500 into 30% into 80%. How many performance obligations should be there? Since this discount is important, is critical, is making an impact, or you can say material, then it should be recorded separately. Other than that, it should be not recorded separately. Since all the customers receive 10% discount, the only additional discount that provides the customer with a material right, okay, is 30% on that product. That is 40 minus 10. Okay, 40 is being given and 10 generally it is given. So only 30% is the additional discount. The entity accounts for the promise to provide the incremental discount as a separate performance obligation in the contract for the sale of product A. Okay, they are asking that it should be recorded as separate performance obligation. Why? Because it is material. The entity believes that there is 80% likelihood. Okay, so calculation is done. 500 into 30% into 80%. It is 120. So now you have 1000 rupees as your product price and standalone price, and discount voucher is of rupees 120. Now this is your total. Now the transaction price. What is transaction price? The price that the customer is that the seller is expecting. Okay, that is rupees 1000. Okay, the transaction price is 1000 that the seller is expected in return for the purchase performance satisfaction, for the performance obligation satisfaction. Okay, so this transaction price of rupees 1000 should be divided into these two. Okay, should be divided into these two, 1000 and 1020. Okay. Sorry. So this 1000 transaction price should be divided in between this product A and discount voucher on the basis of standalone price. On the basis of standalone price. So this is transaction price being allocated on the standalone price. How it will be done? See, 1000 rupees into 1000 divided by 1120, and your 1000 into 120 divided by 1120. Okay, so this is the proportionate method of this is TP, transaction price, divided to allocated to this standalone price. Okay, so that's how 890 to product A and recognize revenue for product A when control transfers. The entity allocates rupees 110 to discount voucher and recognizes revenue for the voucher when the customer actually redeems the voucher. Okay. Next, illustration number 24. A cable company provides television services for a fixed rate fee of rupees 800 per month for a period of 3 years. Cable services is satisfied over time. It is over time. That is simultaneously consumed and all. Because customer consumes and receives benefit from services as it is provided. Okay, simultaneously provision and consumption is being carried on. That is, customer generally benefits each day that they have access to cable services. Determine how many performance obligations does the cable company have. Okay, so each day, each month, bill is being raised and the bill is being paid. Each day the services are being delivered, the connection benefits are being delivered and are being consumed. So in this case, each day, or you can say each week or each month, is separately identifiable, are distinct on its own. Okay, are distinct on its own, are separately identifiable. Therefore, it should be in such case separate performance obligation. But these all performance obligations are of similar nature. Okay, are of similar nature. Therefore, this can be clubbed as series of distinct goods and services. Therefore, this can be clubbed as series of distinct goods and services and should be treated as one particular performance obligation. This is the same way where this revenue, okay, or you can say this cable connection company records its revenue. Read this answer once. Okay, so these are distinct, but since these all performance obligations which are separate are similar nature, are of similar nature, similar kind. So they can be clubbed and can be noted as series of distinct goods and services. Okay, so single performance obligation. Next, illustration number 25. Manufacturer M enters into a 60-day consignment contract to ship 1000 dresses to retailer A's store. Retailer A is obligated to pay manufacturer M rupees 20 per dress when the dress is sold to an end customer. Now you have to see that who is principal, who is agent. Okay, if the control has been transferred, then only you will see that this other one, the receiver, is the principal. Other than that, who has the control is known as principal. The person who is acting on behalf of the principal is known as agent. Okay, now whoever is principal, you have to record revenue as gross revenue, the ultimate sale amount. Whereas if you after identifying the agent, you have to record the revenue only on the commission revenue. Okay, only the portion of commission will be considered as revenue for the agent's books of account. During the consignment period, manufacturer M has the contractual right to require retailer A to either return the dresses or transfer them to another retailer. Manufacturer M is also required to accept the return of the inventory state when the control is transferred. Okay, the control is transferred only when it is sold to the final consumer. Okay, or you can say that it is transferring to any other retailer. Other than that, the control is not being transferred. The control is remained with the manufacturer. Therefore, here M is principal. Therefore, here M is principal. And if we talk about agent, or you can say retailer. Okay, if we talk about retailer, then retailer is agent. Why agent? Because it is just possessing the stock on behalf of manufacturer M. It is not taking any actions without the direction, and also submitting rupees 20 or transferring the amount only on final settlement with the customer, only on the final sell with the customer. Okay, so M here is principal. It will be doing calculation on gross basis. Gross amount will be recorded as revenue, whereas here in case of agent only the commission will be recorded as revenue. Are you clear? See the solution, read the solution once. Manufacturer M recognizes revenue as the dresses are sold at the end customer when it is being transferred, when the control is being transferred, when it is being sold to the end customer. Next, same question, principal versus agent. First you need to identify who is principal, who is agent, and then afterwards record revenue accordingly. An entity negotiates with major airlines to purchase tickets at reduced prices compared with the price of tickets sold directly by the airlines to the public. The entity agrees to buy a specific number of tickets and will pay for those tickets even if it is not able to resell them. So it has entirely purchased from the airlines, and therefore all the risk and rewards are being transferred to the the ticket purchase agency. Okay, now airlines have transferred, airlines have transferred control. Control transfer. To whom? To entity. Because entity is now bearing all risk and rewards. See, entity will pay for those tickets even if it is not able to resell them. Entity will be paying even if it is not able to resell them. Okay, such is the case, then it is owning all the risk and rewards. If yes, then this is the principal. It is owning all the control. The control has been transferred from airlines to the entity. Now, therefore, entity is the principal. Okay. The reduced rate paid by the entity for each ticket purchased is negotiated and agreed in advance. The entity determines the price or at which the airline tickets will be sold to its customer. The entity sells the tickets and collects the consideration from customer when the tickets are sold. Therefore, there is no credit risk. The entity also assists the customer in resolving complaints with the services provided by the airlines. However, each airline is responsible for fulfilling their own obligations associated with the ticket, like making people manage their own transaction, okay, manage their own travel for which they have booked the seat, okay, including remedies to a customer for dissatisfaction with the service. In case of any grievance, airlines need to resolve it. Determine whether the entity is a principal or agent. See, entity has got the control of tickets, okay, it is bearing all the risk and rewards, and therefore it can be termed as principal. Okay, entity concludes that it has the control, it controls the ticket before it is being transferred to the customer. Thus, the entity is principal and should record gross amount. Illustration number 27, page number 3.39. We will read till illustration number 30 in this lecture, and then we will continue in the next lecture. Company D Limited provides advertising services to customers. D Limited enters into a subcontract with a multinational online video sharing company. F Limited, under the subcontract, F Limited places all of the D Limited's customer adverts. D Limited notes the following. D Limited works directly with the customer to understand their advertising needs before placing adverts. D Limited is responsible for ensuring that the advert meets the customer's needs after the advert is played. D Limited directs F Limited. Okay, so D Limited is having a control over F Limited, over which advertisement or to place and where to place, when to place, where to place. Who is directing? D is directing. If control is being possessed by D, then it is known as principal. D Limited does not bear any risk of inventory. Okay, so there were three important points. He should bear risk, he should be in a position to control and direct, and third, he should have discretion to set prices. So here it does not have inventory risk to bear, it does not have discretion in setting the price. Okay, no price setting, no, but one thing is okay, that is D Limited controls F Limited, gives direction where and which advertisement to be placed, and therefore it will be considered as principal. D Limited is principal, does not bear this, even though it is principal. Why? It is directing, it is having control. Next, illustration number 28. Customer buy a new data connection from the telecom entity. It pays one-time registration and activation fees at the time of purchase of new connection. The customer will be charged based on the usage of the data services of the connection on monthly basis. They will be charging on monthly basis, but there is one-time registration. So, one-time registration plus monthly charges. Okay, this one-time registration is providing an access, okay, it is activating only and will further on make the user eligible that it can access the further goods and services. Okay, now this activation fees, the one-time registration fees, is neither a service nor a good, therefore not a separate performance obligation. By selling a new connection, the entity promises to supply data services to customer. Only it is making a promise, it is neither supplying any good or nor a service. It is only making a promise that it will in future carry on to supply the goods and services to the customer. Customer will not be able to benefit from just buying a data connection. Okay, it will not be in a position to identify or take benefit of just the data connection unless it gets the recharge, or you can say monthly payments done. So only buying the data card, or you can say the registration, does not work on its own. So these are not distinct, cannot be identified on their own. The activity of registering and activating connection is not a service to customer and therefore does not represent satisfaction of performance obligation. Entity obligation is to provide data services and hence activation is not a separate performance obligation. Okay, it is not a separate performance obligation because the only getting the connection, getting the registration cannot be benefited on their own, cannot be used on their own. Next, illustration number 29. But before that, we have example number 3. Let's read it once. Where an entity agrees to transfer control of a good or service in a contract with customer at the end of 30 days for rupees 1 lakh, and if it exceeds 30 days, the entity is entitled to receive only 95,000. Okay, so this 5,000 can be done or cannot be. There might be that discount will be given, it might be that discount will not be given. Depends upon a condition, that whether the particular condition will be met or not. The reduction of 5,000 will be regarded as variable consideration because it is dependent on some occasion, okay, some condition. In other cases, the transaction price shall be considered as fixed at 95,000. Now, there are two methods, as you know, we have discussed in the question answer part as well. The upcoming two questions and illustrations are on this. Okay, so whenever there is variable consideration, so if there are multiple outcomes, okay, there are chances of multiple outcomes, then you use the expected value method. Here you only do the sum up, or the average weighted sum up of the numbers, okay, of the outcomes and the percentages. Okay, so this is the expected value. Whereas if you talk about there are chances of only two outcomes, only and only two outcomes, then you use the most likely amount method. Okay. Illustration number 29. XYZ Limited enters into a contract with a customer to build a sophisticated machinery. The promise to transfer the asset is a performance obligation that is satisfied over time. The promised consideration is 2.5 crore, but the amount will be reduced or increased depending on the timing of the completion of the asset. Specifically, for each day after 31st March 2001 that the asset is incomplete, the promised consideration is reduced by 1 lakh rupees. Okay, so if it is pending or it is incomplete for 3 days, then 3 lakh rupees will be reduced. If it is pending for 8 days, 8 lakh rupees will be reduced, 1 lakh of each day will be reduced. For each day before 31st March 2001, if the asset is complete, the promised consideration will increase by 1 lakh. So it can either increase or either decrease. It can be for multiple days, it can be for 1 day, it can be for 10 days, it can be for 50 days. Okay. So your outcomes can be many. There are multiple chances of outcomes. There are chances of multiple outcomes. Okay. So here which method will be used? Which method will be used? The expected value method. Okay. And if we talk about the other part of this question, in addition, upon completion of the asset, a third party will inspect the asset and assign a rating based on metrics. Okay, a rating will be given that are defined in the contract. If the asset receives a specified rating, the entity will be entitled to an incentive bonus of rupees 15 lakh. Okay, so here in the second part of the same question, what is the criteria? That either they will meet the rating criteria or they will not meet the meeting criteria. If they meet the specified rating criteria, they will be receiving 15 lakh bonus. Okay, yes. Or in case if they are not able to meet the rating criteria, they will not be awarded with 15 lakh bonus. Are you clear? So these two chances of outcomes are there. So if only 2 possible outcomes are there, then you will be using the most likely method. Determine the transaction price. Okay, so you have to use expected value method in the first case, and second you have to use most likely method. Are you clear with this? Last illustration for this lecture, and then we'll head towards next lecture. Okay, illustration number 30, estimating variable consideration. AST Limited. This is practical numerical question for the same 29th question. If you are okay and if you are aware, if you have got an understanding about the two methods, you will be finding this very easy. Illustration number 30, estimating variable consideration. AST Limited enters into a contract with the customer to build a manufacturing facility. The entity determines that the contract contains one performance obligation satisfied over time. Construction is scheduled to be completed by the end of 36th month for an agreed upon price of rupees 25 crore. Okay, so your amount is 25 crore. An entity has an opportunity to earn a performance bonus for early completion. 15% bonus will be awarded if it is completed by 30th month. Okay, there are chances, probability is 25%. 10% bonus will be awarded if completed by 32nd month. The chances are 40%. 5% bonus is awarded if completed by 34th month. 15% probability is there. So since there are more than 2 outcomes possible, so here you will be using the average estimated expected value method. Okay, whereas in addition to the potential performance bonus for early completion, AST Limited is entitled to quality bonus of rupees 2 crore if a health and safety inspector assigns the facility a gold star rating. So either they will be receiving a gold star rating or they will not be receiving a gold star rating. If yes, they will receive 2 crores extra bonus. If not, then they will not receive any bonus, that is 0. So there are only 2 possible outcomes in this quality bonus case. Okay, so this quality bonus, here you will apply what? Here you will apply most likely method. In case of performance bonus, since more than 2 outcomes are possible, you will be applying the expected value method. How? See here, answer is given. AST Limited concludes that it is 60% likely that it will receive the quality bonus. So in this case, when there are multiple outcomes, amount is taken how come? 25 crore rupees into 15%. Okay, 25 crore rupees into 15%, 25 crore rupees into 10%, 25 crore rupees into 5%. This is amount that you will be receiving. The chances are 25%, 40% and 15% given in the question itself. Okay, and 0%, 20%. Okay, how? Where it is written 20%. Okay, so remaining is 25 plus 40 plus 15. So remaining is 20%. Okay, this is balanced figure. So no amount will be received. In case, okay, of no amount will be received, and now its probability is 20%. You will multiply this as well. This is 2.125. This is your value with expected value method. Now next, if you talk about the quality bonus, what is the probability? 60%. Most likely is what? Is that they will receive that 2 lakh quality bonus. Okay, so here only 2 possible outcomes. They will 2 crore or nil. This method would best predict the amount of associated with the quality bonus. Okay, which method? Most likely amount method. Okay, 60% is given, therefore 2 crore will be recorded as revenue. That's all for this current video. Okay, please watch the other upcoming videos, and for full course don't forget to check out description box. There is also link given where you can download the app and chat with me in case of any doubt, any query. We'll get back to you as soon as possible. Also you can DM on my Insta to get further details. Okay, this is Swati Gupta, Chartered Accountant, signing off. Jai Hind, Jai Bharat. See you in the next courses. Till then, take care, be safe, stay tuned.